Welcome back. You're watching us here on Chartbusters. Let's talk about the primary market action. The IPO for luxury furniture firm Stanley Lifestyle opens for subscription today, scheduled to close on the 25th of June. The company targets about 537 crore of fundraise, of which 200 crore would be the fresh issue at a price band which is up for you on the screen. They've also raised about 160 plus crores coming in from anchor investors. To know more about the future plans of the company and growth prospects, we are joined by Sunil Suresh, who's the MD, and Pradeep Kumar Mishra, who is the group CFO. Thanks a lot, gentlemen, for joining in. And, you know, that really is the first thing that the street wants to know. 200 crore is the fresh issue that you guys are raising. How will that be deployed into the business? How much of that would be directed towards store expansion? And as a result of which, what would be the sustainable revenue growth trajectory?
Yeah, thank you very much for having us here today. Most of the funds would go for store expansion. What we've actually done is in the last 5 years, we have done a cluster expansion in Bangalore and have 3 different segments in which we are playing. And then we have done the what you call as proof of concept. And we have almost a 40 to 50% market share in Bangalore. So hence we plan to kind of deploy the funds in other cities and grow more in those clusters. So we have been a pan-India brand present for more than 15 odd years in the furniture business. And we have stores, a few stores in all the major metros, but now we want to expand in those metros.
Gentlemen, good morning. Thank you for joining in. Sunil, my question is to you. You mentioned that you would increase your presence in cities beyond Bangalore and grow in those clusters as well. Can you elaborate on which clusters are you targeting?
Okay, so we are a fairly what you call as data-driven company. We are able to understand where the premium housing is happening, in which are the major cities. It's happening in Delhi, Mumbai, Hyderabad, Pune, and Calcutta. So we plan to start expanding in these cities because our business thrives in the tailwind of the luxury housing industry. And now we see a lot of opportunity because premium housing is doing quite well in major metros, and we want to expand in these cities.
Right. So that would be one of the things that we will keep an eye out on. Also, just wanted, Pradeep to come in. Pradeep, the money that will be deployed for store opening, if you could give us a sense, you currently operate stores under 3 brands. There's Stanley Level Next, Stanley Boutique, Sofas and more. What is the average revenue each per brand of these stores? And how many stores will you open over the next 18 to 24 months, and in what brands?
Yes, broadly, we have been adding on an average 10 to 12 stores per annum for the last 3-4 years. And, what we believe is that's a good growth rate in store expansion, that we see for the next 3-4 years as well. And store expansion would happen, evenly across all the 3 formats of Stanley Level Next, Stanley Boutique, and Sofas and more. Right now, the revenue is equally split between them and with a very healthy store economics. And, each brand themselves are, in a positive generating P&L. And I think with more store expansion across the year, we will want to continue that same momentum.
Right. So I'm just, going back to the first question that I asked, which was with regards to sustainable revenue growth. I'm looking at your revenues and the number of stores that you currently have. On an average, the revenue per store is anywhere between 7 to 8 crores. If you add about 10 to 12 stores every year, that means an additional revenue of about 80 to 90 crores per year. Would that be a sustainable growth trajectory to look at in terms of store addition? And what else are you penciling in when it comes to same store? Yeah, go ahead.
Stores take about 4 to 4.5 years to fully mature. So currently we have almost 60% of our stores under 2 years, and they're still in maturity age. So technically, as we keep adding more stores, I think the revenues from the current stores which are maturing, plus the new stores will also increase in terms of how we see the business.
Pradeep, I wanted to ask you about the store expansions. You were mentioning that you plan on expanding into cities like Delhi, Mumbai, and in markets like these, the rent is mostly shooting through the roof. And what is your rent expense as a percentage of your stores? And would that increased rent expense and real estate cost be a risk to your profitability as well going forward?
Yeah. So currently my rent expense, is somewhere between 9 to 11%. We typically, when we operate and when we identify location, that's a very, very important, driver for us. We operate out of very large showrooms. We need that much of space to display, our products and, to give the experience to the customers. So I think that's a very important piece. And I think when we expand into new geographies, location and rent cost is a very important aspect. So we decide, the location is important here. And of course, getting the right location at the cost that we want is a very important, aspect of the overall retail business. Not only for us, but for the retail in general.
All right, so 9 to 11% is your cap on the rent that you're willing to pay as a percentage of sales every store. I'm looking at your margins over the last 2.5, 3 years. They've been anchored around that 18 to 20% mark. What are the triggers for margin expansion from here on? And, how are you likely to look at margins at a store level, at a company level, franchise versus own stores? Sunil, you can go for it.
Yeah, sure. So basically, when you really look at what we are doing is the 5 major metros, we have decided to have only company-owned, company-operated stores. There we are expanding on a cluster basis. In our entire B2C, we are a 100% cash and carry company. So including to the everything that we sell to the franchisee is completely sold out in terms of the model itself. So while we have a lot of inquiries for franchisees all over the country, we're very careful because in the segment where we are playing, it's very important to ensure the market is ready. Sometimes there are smaller towns and cities which are closer to major metros, and the catchment in the segment where we play, the customers normally travel to the major cities and do the purchase there. So very carefully we are growing in terms of COCO as well as FOFO model. So from a margin expansion, what we have really done is we were originally known more as a living room or a sofa brand for almost 10, 12 years. But last 5, 6 years, we have invested in a manufacturing facility capable of manufacturing complete solution for a home. So we are able to provide furniture for every room of the home. That means kitchen, wardrobes, beds, mattress. So we are actually becoming a one-stop shop for a premium and luxury home. Thereby, the average ticket size of a customer who spent about 2 to 3 lakhs with us about 3, 4 years ago is now becoming almost 5 to 7 times more. So that is the way we are expanding our business.
Right. Pradeep, I wanted to ask you about your working capital days. They are currently seem to be on the higher side, and they're stuck because largely in inventory. How do you plan, if you can share a number for that as well, and how do you plan on bringing that down?
See, my average inventory holding in absolute term is, pretty high. And then that number, when you see, when I say it is very high, it is also to understand that these are the inventory which is logged in display inventory when I open a new showroom. So as we expand, for the in geographies, this number in absolute term will keep increasing. And I think, when we do a 15-20,000 square feet of showroom space, it requires a lot of product to be placed in the floor. And actually, that's a kind of an asset that we have where we are able to give a lot of customization offerings, wide variety of choices to the customer. I think what happens is when the store becomes fully matured in 3 to 4 years' time, then we see the real impact of inventory turnaround, really paying off. So we need the stores to get matured for these days to come down.
We still haven't
carry some raw material inventory, yeah.
All right, we still haven't gotten a number from you, so I would just, you can say yes or no. Sunil, with the 25 stores that you're planning to add over the next couple of years, given your current store revenue run rate, is an additional 180 to 200 crore of top line possible because of these new stores in the next couple of years?
Like I mentioned, I think we are targeting 1,000 crores in the next 3.5 years. Like I also mentioned to you, most of the other stores which are not fully matured are going to come to maturity. So we believe that our business, about 80% of our business is B2C and 20 is B2B. That formula will continue, and we are targeting 1,000 crores in the next 3 to 4 years.
All right, 1,000 crores on the top line in the next 3 to 4 years. That's the headline coming in from the management of Stanley Lifestyles. The IPO opens for today. The company is seeking a post-listing market cap of close to 2,100 crores at the higher end of the issue price band. Thanks a lot, gentlemen, with a promise to speak once again when the stock lists, and then we get details and more numbers out of you.